PE firms have a virtually endless list of assets that they could invest in, and LPs have an equally long list of potential GPs to invest in. How does each side decide what's best? The fund strategy is a major factor. In the early days of private equity, a common strategy was to simply use more and more leverage to acquire businesses generating strong, stable cash flows, sometimes called levering up. But today, private equity's competitive ecosystem requires GPs to take a more multi-tiered approach. This means establishing clear, specific investment theses, as well as applying a greater overall emphasis on value creation. A thesis specifies the target asset types. There are two primary groups: financial assets, such as equity in a business, and real assets, like real estate or infrastructure projects. Real asset investing requires specific expertise and often entails a much longer investment time horizon. If a GP decides to focus on financial assets, then it will typically pick from one of three strategic focuses. The majority of GPs specialize in so-called leveraged buyouts, or LBOs, which are the backbone of the private equity industry. To execute an LBO, GPs select mature companies with relatively predictable financial profiles, ones that banks are happy to lend to at attractive interest rates. This allows the PE firm to lever up, combining equity with debt to acquire a larger share of the company and take greater decision power. Plus, leverage injects more cash into the business, which can finance growth and value creation initiatives. Leading PE firms known for a focus on LBOs include KKR, Apollo, and Blackstone. Other GPs invest into earlier stage companies with growth potential. This is called growth equity. These companies often entail higher risk because they are less established and have more unpredictable finances. As a result, banks are less willing to lend at attractive rates, and growth equity GPs require a high amount of equity capital. In general, GPs take minority stakes in their growth equity investments. Some of the leading names in growth equity are Temasek and General Atlantic. Venture capital firms also invest equity in growth stage companies, but tend to invest at an even earlier stage than growth equity investors. There are also GPs who intentionally invest in mature but struggling companies that may even be close to bankruptcy. GPs aim to acquire these companies at a low price with less leverage, use their skills to turn the businesses around, and reap the rewards, a bit like flipping a beat-up old house. This type of strategy is known as distressed asset investment. Some of the leading distressed asset investors are Oaktree and Cerberus. A small but growing trend amongst GPs is investing in secondaries. In this model, which is similar to being a fund of funds, GPs invest in other PE funds rather than purchasing assets directly. There are several additional considerations that a fund strategy will likely cover, such as the investment size, industry, and geography. Let's look at each in turn. The fund strategy determines a target fund size, and with it the size of assets the fund will target. Sizes are usually classified into small cap, medium cap, and large cap, where cap is short for capitalization. Small cap companies generally have annual revenues ranging from a few $1,000,000 up to $100 million, whereas large cap companies can have revenues closer to or beyond $1 billion. In practice, the boundaries for each segment vary by market and industry. Many GPs will also choose to specialize in a particular industry or geography, since effectively executing a value creation strategy often requires relevant expertise. The fund strategy, together with its track record, is the value proposition that GPs use to attract potential LPs during the fundraising stage.